So in this video, I want to show you exactly what IRR is. I know I touched previously on the fact that IRR is better for overall wealth building, but I want to show you some examples here so that you can have a deeper understanding of exactly what IRR is and how that's going to impact your life. So I'm going to share my screen. We're going to walk through a couple of examples, and I'm just going to riff here to show you guys how this process works. Okay, so I'm going to show you and teach you the skills you need to actually go out and make this for yourself. Okay, so let's scroll down here, blank page, and I'll show you how it lays over. But like I told you guys earlier, that IRR is just general wealth building. So what's so cool about IRR that cash flow doesn't do is that IRR considers cash flows annually, and it also considers the end equity portion. Again, if we go back and look at our example from our pro forma, what IRR is going to do is it's going to consider each year how much cash flow we get, and it's also going to consider the equity when we do decide to sell. Okay, and that's what's so powerful about these sheets is it gives us IRR every single year. So let's just go and look at a blank page here. So I'm going to teach you guys how to actually calculate IRR for yourself in Google Sheets. What I want you to do is equals an inner sign equals open parentheses. IRR open parentheses. And then you can choose a timeline. So IRR, in order for it to be valid, there has to be some sort of an investment amount because of the fact IRR is measuring your return on that investment, the rate at which that investment grows and compounds a year. Okay, so for that to be true, we have to have a year zero, and a year zero is essentially when we invested the money. Okay, and then year one, well, let's look at a 5-year time frame: 2, 3, 4, 5. Okay, so year right here, zero. And let's say that for simple example, we invested $100. What I want to do is I want to have negative 100 because it's a negative amount. That means I invested it. Now let's say, and let's just go over here. Let's say that in year one, we received $8 in cash flow, 9, 10, 11, and 12. Okay, so what I want to do to calculate my IRR, to measure that, I want to equals IRR, open parentheses, and I want to measure this. So what I'm going to do is I'm just going to open parentheses IRR. I'm going to start with our investment, and I'm going to just drag over all of these, and I'm going to hit enter, and it's going to show me what my IRR on this project is. Now, if you look at this, it says the IRR is negative 18%. And to me, that makes a lot of sense. I want to tell you why that makes a lot of sense, because I don't have any equity amount here. This is just cash flows. Okay, so in terms of this investment, if we're looking at cash on cash, obviously we invested $100, we received 8. That's an 8% cash on cash. In year 9, that's a 9%, 10%, 11%, and 12%. So somehow those are good, not great cash on cashes, but they're healthy cash on cashes. Yet our IRR tells us we're making negative 18%. So how does that make sense, right? Well, here's the thing is that IRR is, again, measuring the rate at which this $100 grows compounded a year. And essentially this $100 really hasn't grown at all because we haven't even in total, we've only received $50 over the course of 5 years. So IRR is not very happy with this computation. But let's say that, let's say that we didn't actually increase the value of the property, and we sold the property and we got our initial money back. So what we would do is in this year 5, let's say we sold it in year 5, what we'd want to do is, let's say we got our $100 back in year 5. So I'm going to do 100 plus 12 so that in year 5, I receive $112. And let's see what happens to our IRR. So boom, right there, it tells us now our IRR is 10%. Okay, so what happened is it now collected information, even though we earned 8, 9, 10, 11, 12, saying our money grew at an average of 10% a year. Let's see exactly how much it's saying it grew at. So 9.81% a year. So here's what's cool about IRR is not only is it going to measure this number over here and calculate, but if I change this number here, let's say I turn the 8 to 9, let's see if our IRR changes. Boom, it's going to go up to 10.5%. Let's say it goes down. It's going to go to 9.58%. So the cool thing about IRR is not only is it measuring cash on cash, but it's measuring overall value. And let's say that, let's say it happened successfully in terms of adding value to our property. And let's say we came through and in year 5, our $100 investment, whenever we sold the property, turned into $150, and we received $150 from selling that property, and we received $12 in cash flow. Let's see what happens to our IRR. Boom, our IRR goes up to 16%. Okay. Now here's another very interesting thing. Let's say that we received all this money, which totals $199, and instead of over the course of 5 years, let's say what happened if all of that, let's say we got $199 in just 1 year of holding the property. So let's see what happens to our IRR. Essentially what I'm going to do is I'm going to want to change my IRR time frame, because I don't want to measure all of these. Instead, I just want to measure from year 1 to year 2, or from year 0 to year 1. So I'm going to come in here, I'm going to delete this, and I'm going to tell it that I only want to measure from here to here. And I'm going to come in and I'm going to change this number to 199. Boom. Well, now I'm returning 99% a year. Okay. So as you can see, let's say I did 7% here, and let's say I did 199 here. I again have to change my time frame. Now I'm earning 44% a year. Okay. So what's so powerful about IRR? I'm throwing a lot of numbers at you guys, and I'm really just throwing them out there because I want to prove the point to you that whenever we are looking at real estate, and let's go back and look at our pro forma, right, is that there's a lot of numbers going on this page here. And according to what I do, my vacancy rates, my income rates, my expenses in different years, and especially with different forms of debt pay down, equity increases. Again, like let's go look at our IRR here. If year 5 IRR is 37%, and let's go back to our pro forma and change this number, value increase from 2% to 4%. Now let's go look at our IRR again. It was at 37. Now it's at 40. So measuring IRR, even though our cash on cash didn't change, we can tell and compare apples to apples, one investment to another. And that's extremely powerful because, again, you want to know your goal, right? Whenever we first started this, I said you want to know your goal, pick out a cash on cash number that works for you, pick out an IRR number that works for you. For me, my cash on cash is 15%, my IRR is 30%. So if I'm comparing apples to apples, investment to investment, it's really hard if I'm just looking at these numbers to know, hey, what is an actual opportunity, right? I don't really know just by looking at these numbers. I can't compare year 8 to year 9 of one investment to another to a third investment, and cash on cash is good. That's where I want to be able to systemize and have a basis for how I want to look at these projects, because I want to be able to compare exactly, is this investment better or is this investment better according to my underwriting? And that's what's so powerful about IRR, is that it's going to take into account a couple things. One, it's going to take into account how much you invested. So you could compare a $100 investment to a $120 investment and figure out what's best. You can compare timing of cash flow. So what's extremely powerful about it is that it takes into account the timing of how much money, not only how much money you're receiving, but when you're receiving that money. There's a rule in finance that says $1 today is worth more than $1 tomorrow. Because if I receive $1 today, then I can reinvest that money and begin to earn interest on it. Versus if I receive $1 tomorrow, that's one more day of interest I can't receive. So what IRR does is it prioritizes receiving more dollars sooner. So you may find that, if you were to receive $100 today versus $500 in 10 years, you may be better off taking that $100 today and reinvesting it at a rate of return. So this is what IRR is trying to tell you. It's trying to tell you, how much does my money grow year over year over year, compounded on top of the year before. And that's why I love IRR. It's a super complex calculation, but the great thing is it can distinguish it down into one number that's going to work best for you. And that's what I really like about it. So whenever you guys are looking at IRR, again, you want to go back and know your goal. Do you want wealth building, or do you want straight up cash flow for financial freedom? So if you're looking at one or the other, and you can look at both. Even if you're wanting cash flow, it doesn't hurt. Say you have 2 projects and both are 16% cash flow, then you're going to want to say, hey, okay, well, they're both the same cash flow. What's the IRR? And then prioritize the higher IRR project over the other. Another thing it's going to do is it's going to tell you at what point do your returns start to diminish and flatten out. As you can see, there's a pretty significant decline in IRR from year 1 to year 7, right? It goes from almost 200% a year to 30% a year. So it's something to consider. IRR, 30+% IRR is amazing. I tell you guys, most investors are pretty thrilled to get 10% IRR. Just long-term wealth building in the private equity markets. People are very, very excited to earn 12 to 15%, with 18 to 20% being amazing. But again, we only want to be selecting the cream of the crop projects. We want to select projects that are going to super, super boost our wealth. And I know the difference between 20% and 30% may not sound like a big deal, but over a long haul, 10% going from 20 to 30 is a pretty huge deal. So I just wanted to show you guys how IRR works, what you should be looking for, and how to make decisions based off of that. See you guys in the next lesson.